Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This, of course, is the podcast that will make you a smarter investor. How do I know? Because I'm sitting here producing it all most of the time, along with our producer Ray in the back. Before we get to our featured interview of the day, I have to do the stock of the day. Our stock of the day is none other than Starbucks. And now this was also my stock of the day about a week ago, but I'm making it again my stock of the day for a couple reasons. First and foremost, Yahoo Finance, yours truly, and our senior reporter Brooke DePalma sitting down with Starbucks new CEO Brian Niccol later on today. That interview will drop in the 3 p.m. hour on Yahoo Finance. Here's your three things that I want to hear from Brian Niccol, who I've known for about 10 years, going back to his days at Yum Brands leading Taco Bell. First up, how will he improve employee relations? There's probably more that he needs to do here besides just giving them a fatter paycheck. Number two, cost savings. This is a company that has outlined about $1 billion a year in cost savings over the next 3 years. We'd love to hear from Brian if that is still the correct number that analysts should be plugging into their model. And number three, China. Now, I think Brian is getting ready to head over to China, where Starbucks operates about 6,500 stores. I think he has to figure out within the next 18 months, is this a franchised opportunity for Starbucks? Reduce that overhead costs on Starbucks, make it a franchise business, improve the margins, and reinvest in the U.S. So really big interview for the Yahoo Finance team. Brian Niccol coming on Yahoo Finance. That interview was dropping in the 3 p.m. hour. Okay, now on to our featured guest, someone that I have followed for many, many years. Learned a ton from him on all things markets and investing. That is Lawrence McDonald, founder of the Bear Trap Reports, author of How to Listen When Markets Speak. But Lawrence, I remember reading your book, A Colossal Failure of Common Sense. Holy cow. I mean, you took us inside the downfall of Lehman Brothers. I got to tell you, bro, that book changed my career.
Thank you, Brian. You know, as a former Lehman trader, I tell my wife once a month, if we sell 1 million books, we'll break even on our Lehman stock.
Wait, you still own Lehman stock? I didn't even know that was possible.
Well, no, back then you couldn't sell it, so we had restricted stock units, and you know, we took a big hit, but it's been great. And the new book, I'm really excited. The first book's in the top 20 all time at the CFA Institute across a lot of New York Times bestseller. But the second book's doing quite well. It's a good read too. Thank you.
You just brought me back to me failing level 1 of the CFA about 12 years ago. Thank you for that. You know, it was talking about having no life. I mean, that's CFA. They hand you like these, not to go off on a tangent, but they hand you like these 5 books. I'm like, what the hell is this? I'm like, I still have a day job. I mean, how can I study these 5 books and still, I don't know, and still study for this test? It was wild. But nonetheless, I understand you've been working the phones all weekend. Of course, this podcast drops a day before the presidential election. Help us get inside your head. You know, what are some of your biggest concerns after the election, and where do you see some opportunities?
Well, we work with institutional investors around the world, and one of the things we're hearing, if you think about the Lehman fiscal and monetary response, right? So the Lehman crisis was about $4 to $4.5 trillion. But the fiscal and monetary response to COVID, the regional bank crisis in last year, and the election. In other words, we're juicing fiscal spending in Washington into the election. If you add all that up, it's about $16 trillion. Okay, so think of Lehman, $4 trillion. Now we're at 16. And so that's what's freaking out the bond market, because when you talk to institutional investors, what Yellen has brilliantly done, but it's a very dangerous move too, is she's essentially taken, say you have to borrow $2 trillion. See, she's issuing it on the front end of the curve. So T-bills, right? They don't move much in price because they mature within 6 to 9 months or a year. And so what she's done, she's issued a crazy amount of T-bills and pushed longer dated borrowing into next year. So the new Treasury Secretary is going to have a big mess to clean up. But Yellen was able to keep bond volatility down the best she could in an election year. And but everybody knows that next year we're going to have to issue a lot more 10-year bonds, a lot more 30-year bonds. There are less buyers in the world than there were 4 or 5 years ago, and that's starting to freak out the bond market. And that's putting some risk underneath the surface that many people can't see.
I was checking out your blog, and I want to make sure I have this number right, because you did put some numbers around this. $15.5 trillion in debt is coming due. Like, when does that come due, and what does that mean to markets?
Well, it's all between 24, 25, and 26. But what, like I said, what she's been doing is she's been issuing all those T-bills the last 24 months. And so next year, I think if Trump wins, the fear is that the new Treasury Secretary It'll be just like Reagan with Carter, where what they'll do is they'll blame everything on Biden and Harris, and they'll start terming out the debt, and that interest rate move will be blamed on the previous administration, just the way Reagan blamed everything on Carter. And they'll take the pain early, but then hopefully by the end, if you remember, in 81, Reagan took the pain with Volcker, and then by 84 he won 48 states in the 1984 election. It was one of the biggest landslides of all time. So that's I think that's the Trump game plan if he wins.
What does pain look like?
It's like a lot more longer dated bond issuance. Tariffs. Now here's the other thing about tariffs. Scott Bissett is one of the top minds, former Soros Key Square CEO, Soros PM. He has been essentially going to be part of the Trump team, and he's been talking to hedge funds the last 3-4 weeks about this tariff plan. And it's Pollyannish in the sense that, okay, what they're trying to do is we've taken 5 million jobs out of the United States. I talked about this in our new book, When Markets Speak. So both parties have decimated the Rust Belt over the last 20 years. We've taken 5 million jobs out of these states, and we've exported them around the world. The theory is that you'll kind of violently threat tariffs against, even much higher than they are now, against our foes and our allies, and try to bring those jobs home. The problem is, here's the tricky, sneaky part about this. If Trump's elected, because of these tariff fears, if you're Walmart, you're going to try to front end those and basically import a lot of goods before the tariffs go into effect. And that could be pretty inflationary. And so that's where you get into some pain with even higher inflation near term, higher bond yields, some pain early, and then hopefully the Trump team will try to fix that over 4 years and bring some jobs home. I'm not saying they can do it. I'm just telling you that's the plan.
For as long as I've been doing this, Larry, and I've been doing it for a lot longer than it appears on camera. I know I think I still look youngish, but I've always heard that deficits, they're growing, they're ballooning. But I'm listening to you. It sounds like we are on the cusp of a situation where markets finally need to give a damn about deficits. We always try to push it out into the future. Another generation will have to worry about it. But maybe it's right now we need to worry about it.
Well, let's just think, Jay Powell, we're going to get a rate cut this week. It's like 98% probability. So he's basically just cut rates 75 basis points into an Atlanta Fed that's telling us GDP is 2.3 to 3.3, somewhere in there. And your fiscal deficit as a percentage of GDP, just keep it simple, is about 6 to 6.5%. Fiscal deficit in Washington. The average for the last 40 years is like 2.3%. And so, so this is one of these situations in Washington where the hubris on both sides, I mean, you can blame Kevin McCarthy and the Republicans for raising that debt ceiling. They allowed this to happen, and the debt ceiling comes due next year in January.
That's what I was just going to ask you about. I mean, are we near that point? It's coming, of course, soon after the election. I mean, maybe we just can't get an agreement on that.
Yeah, that's where what I'm hearing from accounts. So we've been doing these ideas dinners in London, New York, Zurich with all the hedge funds and mutual funds. And I'm getting more and more and more questions about a Liz Truss moment. And all that means is there was a moment in October 22 where the bond market really body slammed the United Kingdom government. And so when you have a new government that puts in kind of altruistic plans that could work over time but look pretty Pollyannish, the bond market at some point steps up and body slams you, and that could happen to the Trump agenda, especially after the Biden team just ran almost a $2 trillion deficit this year with 75 basis points of rate cuts. So that's pretty. We're in a really that's a crazy world where you're cutting rates 75 basis points and spending close to $2 trillion of deficit spending in 1 year.
How would you grade the job of Jerome Powell, Fed chief?
Oh boy, the first part where they Yellen and Powell lectured us in all of 21 and a lot of 22 that inflation was transitory. So they did a really bad job. So yeah, I give them a D there. Back now, I mean, I think that they're cutting rates when they haven't really killed inflation. So to me, it's a lot like Arthur Burns. In say from 1968 to 70, inflation actually picked up quite a bit. Arthur Burns was the Treasury Secretary. He raised rates and then laid off. And so I think that's what's happening now, where we got inflation down from the 22 highs. They've kind of taken their foot off the gas instead of like really going after it some more. And now inflation's bouncing back, pretty hard. So yeah, I give them on this leg. I'd probably give them a C.
Well, not good grades in either case, but the fact that they're now cutting rates is the Fed sowing the seeds again for a new level of inflation, or inflation, I guess, just staying sustained high at some levels. Look, Larry, when I go to the grocery store, yeah, sure, prices may feel a little bit lower than they were a year ago, but to me, they still seem high.
Brian, they'll never tell you this, but what we talked about in our book, When Markets Speak, is the only way out of a $35 trillion debt hole. There's two ways out. The debt is so big that they could have a debt jubilee where, that's a big default. We've seen that in Argentina over and over and over again, right? Or they can inflate their way out. And that's where they want over time to keep interest rates below the rate of inflation. And when you do that, you will inflate your way out. And that's the whole theory. And that's why I think it's nearly certain that we have a violent snapback in inflation over the next year. Right now, there's how can people make money? There's 23 trillion in the NASDAQ 100, right? 23 trillion. The amount of money in hard assets, commodities, relative to growth stocks has never been smaller. So we think we're going to have like a $6 to $8 trillion, what we call the great migration of capital from growth stocks back to commodities over the next 5 years. So your 401k essentially has been hijacked by 5 or 6 companies. Mm-hmm. And we're starting to see the Microsofts of the world, these big tech companies starting to buckle relative to hard assets and commodities. And I think that's the beginning of a very powerful trend.
Hang with us, Larry. We're going to go off for a quick, short break. We'll be right back on Opening Bid. Welcome back to Opening Bid. We're, of course, hanging out here at the NASDAQ market site in Times Square, our favorite location, having a great conversation with Larry McDonald, founder of the Bear Trap Reports, author of the new book, How to Listen When Markets Speak. Larry, you mentioned hard assets, and this is a conversation I've had of late on Opening Bid with Judy Shelton from the Independent Institute. She's a fan of gold. Why do you think gold is having this moment? Like underneath the surface, what are some of the drivers? And given where our debt position is in this country, can gold continue to climb to new highs?
Okay, I talked to a famous hedge fund manager in the UK last week, and he opened my eyes to something that I quite hadn't thought of. So think of the coupons. So interest rates have gone up the last 2-3 years. So if you're an emerging market country, you're getting higher coupons on your treasuries, a lot higher, like 2-3%. So you just say you're the finance minister or you run the central bank of Indonesia or India. You've got all these extra coupons coming in, and you just witnessed over the last 10 years, U.S. has been the hubris level in Washington around sanctions, property confiscation, sanctions has been really crazy from Republicans and Democrats. So if you're in the central bank of one of these emerging market countries, you've got all these extra coupons. You're not that comfortable with the U.S. in terms of sanctions. You're probably going to take those coupons and buy some gold. Remember, gold is a $16.5 trillion pool of liquidity. Don't ever forget that for people watching us right now. Bitcoin's like 1.4, 1.5 trillion. Gold 16.5. And so gold's only one of the biggest pools that these guys and gals can play in globally. And so that's essentially the big driver, is that there's a lot of extra coupons. And what we talk about in the book is the sanction abuse over the last 10 years. Sanctions should be used very carefully, but it's hubris in Washington. We've really hammered these sanctions across multiple countries. And I'm not saying the dollar is going to lose its, reserve currency status, but at the end of the day, is that decaying away because of aggressive sanctions? Yeah, they're buying gold.
I knew I was a total dumbass for buying a silver necklace about a year ago. I mean, realistically, I should have went to Costco and get some of these gold bars they're selling. I mean, holy cow, you can't even find these things in stock. But of course, this whole conversation comes against the backdrop of presidential election. We're taping this opening bid episode right before the election. And I really loved how recently, and I believe in a blog post, Larry, you laid out some potential Trump stock winners and potential Kamala Harris stock winners. And you say if President Trump wins the presidency again, Tesla could be a winner. Why is that?
Well, Elon has really invested in Trump. And what we've seen with Tesla over the years is that when they have help from Washington, the stock does really, really well. And so there's a lot of things going on with battery power and pieces of legislation that are going to be created over the next 2 years. And it's very clear to us that if Trump wins, Musk is going to have a very heavy hand in influencing and basically negotiating and try to put forth his agenda for the green agenda for Tesla. Yeah, so that's the thing. The thing that's really weird, Brian, is that the Trump trades, think of private prisons. Mm-hmm. They're up like 30-40% into the election. They have huge downside if Kamala wins. And you think of the banks like the XLF or the KRE, they're pricing in a real deregulatory regime. Like they're pricing in a Trump win, not so much a Kamala win. So if the polls have tightened a lot, but the Trump trades over the last 2-3 months have really outperformed the Kamala Harris trade so far. Just look at the solar names or look at the cannabis names. It's so far, I guess if you're a betting man or woman, the cheapest trades on the board relative to what the polls say are the Kamala Harris trades.
As someone that has really spent decades involved with debt of various forms, where does your mind go when you hear Elon hopping on the stage as he did at Madison Square Garden and say we can cut $2 trillion out of the government budget? What does that do to the debt markets? What does it do to markets, stocks for that matter?
That's the thing. Over time, they can cut some fat, but there's a big establishment in Washington. It's very difficult to cut that much over 4 years, and that's once again pretty altruistic. They will cut, but in the meantime, like I said, all that bond issuance that has to be basically sold in the first half of next year, and the tariffs are very inflationary. But if over the course of 4 years, if they are able to cut some spending, right now you're almost a $2 trillion deficit. If they cut that down over 4 years, that becomes, over time, that'll become less inflationary. So you have this first half of the administration is pretty high inflation, and then their goal is to get things down, by the end, and then give J.D. Vance the next opportunity in 28.
And then also on your list, if President Trump wins the White House, Bitcoin. Why is that?
Well, Bitcoin. Bitcoin once again is the reserve as the reserve currency, or as the fiat problem with debt. That's your go-to, right? So and Trump's very friendly around. You just look at Trump's potential head of the SEC, Trump's Treasury, Trump's Fed. It's going to be very Bitcoin friendly relative to Biden, relative to Kamala Harris. And, Kamala Harris and that team, they've tried to reach out, but it doesn't look very genuine, because if you just look at the whole setup, I guess Trump is promising that crowd on the Bitcoin side a lot more. I would say the one problem with Bitcoin is that when there is some market volatility, because it's not as liquid as gold, you get these big drawdowns. So you want to be, as a young person, if you're looking at Bitcoin, you want to save some of that dry powder for those 50% drawdowns, because you're going to get them. You've had 50% or more drawdowns since 2017 with Bitcoin. The largest drawdown for gold the last 10 years is 22%. With Bitcoin, you've had 4 drawdowns of more than 50%.
And if Vice President Harris wins, you have cannabis, solar, and healthcare doing well. Is there one sector you think, Larry, that won't do well?
Under Harris, it would be the banks, because regulatory regime, the financials here look pretty crazy and rich, and I think the biggest one is the financials, the regional banks, and the big banks.
As we're coming up against time here, Larry, we like to ask all our guests their takeaway, wherever it goes, wherever your head, whatever you're feeling right now. What do you think's what's your hot take on what investors should be doing after the election, those 3 days after? How do they protect and build their wealth?
Well, if Trump wins and he has the House and Senate, that's going to be really bearish for bonds because that's going to freak out the global bond market. In other words, the 10-year and 30-year bonds are going to go up more in yield, and they're already pricing some of this in. So the market could really get hammered near term if Trump wins, because there's 230 trillion of debt today in the world. It's 10 times more than the 80s. So every 10 basis points up in bond yield, then all of those commercial real estate loans, all of those corporate bonds, all those treasuries go down in value. And so if Trump wins with the House and Senate, it's really, really bad near term, maybe down 20, 30%, I think. If Kamala wins in a blue wave, then we're down 20, 30% as well, for a whole bunch of different reasons around the market being afraid of a big blue wave. But if you get a win by Kamala or Trump with a split government, that's probably the best possible outcome for stocks. And so that's where you could have some. But at the end of the day, think about this year. We're up 47% into the 2016 election, 47% year over year.
Thank you, NVIDIA.
And, yeah, God knows, what NVIDIA's close to 150%. So whereas in 2016 to 2020, the market was actually slightly down or up a little bit relative to. So we've priced in a lot of goodwill, and I think there's a big mess to clean up in 25. So if you had a good year, take some profits, raise some cash, and just sit in the boat and wait for those really good opportunities that are going to appear, next year and the year after when we get. Always remember, as the first year of a new administration, equity returns are really, really poor. In the second year, you typically have a very, very good year. And so you always want to think like, okay, you want to have raised cash into the first year of a new administration, and the second year, typically returns are outstanding.
I think after this election cycle, Larry, we all could be well-versed to hang out in a boat with about 10 drinks. It's been a hell of an election season cycle. We'll leave it there. I know you're a busy guy. Thanks for making time with us. Larry McDonald, founder of the Bear Traps Reports, author of the new book, How to Listen When Markets Speak. Really good to see you. Looking forward to staying in touch.
Thanks, Brian. Thanks for having me.
Appreciate it. All right, and that's it for the latest episode of Opening Bid. Be sure to hit us with those 5 stars on Spotify, those likes on YouTube, those likes on Apple Music, wherever you find Opening Bid. Just continue to show us that love. We feel it. And, of course, get out there and vote.